have probably heard that FDD professionals analyze financial statements, EBITDA, working capital, and net debt. But what they do actually do on a day-to-day basis? Let's explore. Do they just sit with Excel sheets all day? Not sure. And what exactly happens when an FDD project starts? In today's video, I'll take you through the actual work of an FDD professional from receiving the data to delivering the final findings to the client. So, hi everyone, welcome back to my channel, and if you are new here, I am Soumya, a chartered accountant and having 7+ years of experience in the financial due diligence. So, in my previous video, I explained what financial due diligence is and why it is performed in M&A transactions. So, today let's take the next step and try to understand what does an FDD professional actually do. So, first, let's understanding the business. The first thing we need to understand is the business itself. So before jumping into Excel, we need to understand what does the company actually do? What are its customers? How does it make money? What are its key revenue streams? What are the major costs? What are the key business drivers? Because numbers without business understanding don't really tell you the complete story. For example, imagine a company has grown its revenue by 30%. On paper, that sounds great. But an FDD professional used to ask, why did revenue grow by 30%? What is the reason behind that? Was it because of higher prices, more customers, or maybe some acquisition, or perhaps one large customer contributed disproportionately to the growth? So that's where the real FDD analysis actually begins. Now come on to the second parameter. It's analyzing the P&L. The next major area is the profit and loss statement. We typically look at historical financial performance and try to understand the company's revenue, gross profit, EBITDA margin, and of course the list is endless. But we are not simply checking whether the numbers add up. We are actually trying to understand the underlying performance of the business. For example, if EBITDA increased from 50 crores to 70 crores, that's a 20 crore increase. But we need to understand, is this 20 crore increase sustainable? Maybe 10 crore came from genuine operational growth, but another 5 crore could be a one-time benefit. And perhaps another 5 crore relates to an accounting adjustment. So the question is not simply what is the EBITDA. Actually, the question is what is the sustainable EBITDA of the business. That's the real question if we are looking into the P&L. Another very important parameter is the quality of earnings or the EBITDA adjustments. So this brings us to one of the most important areas of FDD. That's the quality of earnings, and I know most of you heard about that. So the objective is to identify items that may not represent the company's normal or sustainable operating performance. Let's quote an example. One-time legal expenses, restructuring cost, exceptional expenses, non-recurring income, owner-related expenses, certain unusual or extraordinary items. Let's take another example. Suppose reported EBITDA is 100 crores. During our analysis, we identify a one-time restructuring expense of 8 crores. Now, if that expense is genuinely non-recurring and meets the relevant adjustment criteria, the adjusted EBITDA could potentially be 100 plus 8 is equal to 108 crores. But, and this is important, not every unusual expense automatically becomes an EBITDA adjustment. We need to first understand the nature, recurrence, and underlying economics of the item. Next parameter is a working capital analysis. And of course, in this, we used to analyze the working capital. So working capital generally includes items such as trade receivables, inventory, trade payables, other operating current assets and liabilities. So in FDD, we are interested in understanding the normal level of working capital required to operate the business. For example, imagine a company normally requires 50 crores of working capital to run the business. But at the transaction date, working capital is only 30 crores. That could potentially mean the business has been operating with an unusually low level of working capital. and that becomes relevant when determining the normalized working capital requirement or the transaction's working capital mechanism. So again, we are not just looking at a number, we are asking, is this number normal for the business or not? Now, another parameter is a net debt, and that's again a very important part of the analysis. And this is something that can directly impact the transaction value. A simplified formula is, of course, everyone knows, net debt equals to debt minus cash. But in an FDD, the analysis can go much deeper. We may need to understand items such as bank debt, shareholder or related party loans, lease related items depending on the transaction framework, deferred consideration, certain debt like items, other items that may have debt like characteristics. So the exact treatment depends on the transaction and the agreed definitions. Now here the key question is, what are the debt like obligations that the buyer may effectively be taking on? So these kind of questions we used to ask in an FDD deal. Now come on to the different question. It's buy side versus sell side FDD. So FDD can broadly be performed into two perspectives: buy side FDD and sell side, which also known as a vendor FDD. In buy side FDD, we are supporting the buyer. The objective is to help the buyer understand, what am I actually buying? We are looking at risk, sustainable earnings, working capital, net debt, and other financial considerations. In sell side FDD, the seller is preparing for a potential transaction. So here the objective is often to present the financial performance clearly and proactively that could ask potential questions by the buyer. So although the underlying financial analysis may overlap, but the objective are very different. Next parameter is the working with the management. So another major part of FDD is interaction with the management. FDD is not just about sitting in front of Excel. There are usually management discussions and Q&A sessions where we ask questions about revenue movements, customer concentrations, margin fluctuations, one-off expenses, working capital movements, debt and debt-like items, business trends, and sometimes the most important information doesn't come directly from the financial statements. It comes from when we ask the right questions to the management. Now, another parameter, and this is the last and very important step in every deal. It's preparing the FDD report. After completing the analysis, we bring everything together into a FDD report. The report generally communicates historical financial performance, revenue analysis, EBITDA and QE, working capital, net debt, key findings and risk, other transaction relevant observations, and this is where an FDD professional needs to convert a huge amount of financial data into clear, concise, and commercially relevant insights. Because the client doesn't want to read 500 pages of Excel. They just only want to know, what does this mean for my transaction? So this is very important part when it comes to a deal. Now, so if I had to summarize the role of an FDD professional in just a one sentence, so we don't just analyze numbers. We try to understand the story behind those numbers and identify what matters for the transaction. And that's what makes FDD so interesting. In my next video, I'll cover one of the most important questions I get: FDD versus audit. What is the actual difference in a detailed manner? So if you are a CA, finance professional, MBA student, or someone looking to enter FDD, make sure you subscribe, because I'll be covering FDD concepts, interview preparation, career guidance, and real world examples in my channel. See you in the next video. Bye-bye.